So how can you protect your money? 7 Action News reporter Kim Russell going in depth, taking a look at some of the pros and cons of different investments.
Now, we know that the stock market is not the whole economy. It is just one aspect of it. But all too often lately, we are seeing a lot of red on a lot of days. And it has a lot of people wondering what's about to come in our economy.
We're lucky, I'm employed, and that's, lots of people aren't.
We are lucky, it's true, because we have our families, we're healthy.
New parents Clark and Greta feel grateful for what they have. But as the Federal Reserve raises interest rates to lower inflation, they're concerned. Inflation might be so powerful, fighting it could lead to a recession. In response, they saved money in high-interest CDs and also took on some risk, hoping for reward.
We try to invest the money wherever it's possible, where there's still any worth left. And so that's our strategy, buying gold.
If you expect interest rates to continue going up, okay, then you want to sort of lock in your loans right now.
University of Detroit Mercy Dean of the College of Business Administration, Joe Eisenhower, has a PhD in economics. We asked him what people can do in this kind of economy. He says if you expect a possible recession, increase your savings. And if you have funds to do so, invest in multiple places.
Many people own a home, and that is an investment. If you have money in banks, that can be a type of investment. If you're in the stock market, that's another type of investment.
Dean Eisenhower says whether you should invest in stocks or not right now depends on your risk tolerance and when you're going to need to cash out. For example, historically, stocks over the long run offer higher returns than bonds or CDs. So market dips offer an opportunity to buy low.
You'll see a dip. And if you were looking just at that moment, you might say, oh my gosh, the stock market is declining, I need to get out of it. But then right away you see that there's a large increase.
But if you're going to need the money soon, you might want to invest in CDs or short-term bonds. If you won't need the savings for a year, I-bonds are an option. You can buy up to $10,000 worth of I-bonds through the U.S. Treasury's website each year, and the interest is based on inflation.
These are backed by the U.S. Treasuries, so their risk is very minimal.
Oakland University assistant professor Pratik Kathari says the interest I-bonds pay has been hard to match recently. He says his research has been on predicting aggregate stock market returns, and things, frankly, don't look that great in the next year or so. As a result, he invested in I-bonds for the short term and in the stock market for the long term.
It's a long-term game. Don't be faced by current volatility for the next few months.
The message from both Professor Kathari and Dean Eisenhower is to have a long-term plan in place to ease stress. What's the biggest mistake people make?
Panicking. Over time, the economy will continue to operate as it normally does.
In Detroit, Kim Russell, 7 Action News.